All right, we have all kinds of stuff to talk about today. Let's talk about the volatility. Let's talk about the market's woes. Let's talk about how to trade UVXY and VXX. And let's talk about all kinds of other stuff coming up next on the Short Vol Show. Stay with me. All right, folks. So welcome back to the Short Vol Show. I haven't seen you in a minute, as they say out there in gangster land. Not been a time of great profitability to be short volatility, as we have seen the market in its down trend for a while now. It seems like the market's down every day. The E-minis being up 35 this morning seems like no big shakes, like, oh, it's only, big deal, it's up 35, because the trend is so brutally to the downside that it almost seems like it doesn't really matter. So let's take a look at the chart of the E-mini, which is kind of like the most important thing that I've been looking at lately, real quick. And after that, I'm going to get on to how you can short volatility if that's what you want to do, and we can talk about some other things. But for right now, here is the chart of the E-minis, which is a basically the market. And we've seen the last few sessions just down, 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 down. And every time it looks like, well, maybe it's going to come back up, it's back down. Now, we're up today, but it could just turn and go right back down. And we're in a downtrend now for the last few sessions. So hasn't been a great time to short volatility. Let's go and check out next to the chart of the VIX. This video is brought to you by Gorilla Trades, and I am using Thinkorswim platform to show these various charts. So here is the chart of the VIX for the last, I think, 20 days, 10 days. And we see, this uptrend on the VIX. We didn't surpass that spike on the 10th. Remember, if we go back to our E-mini chart, the 10th was a, it's not even on this chart, but let's back this up a little bit. The 10th was this move right here, and that was sort of a more violent move than the rest of these, thus the bigger spike in the VIX. If we look at the various futures, I have the various VIX futures here on my my watch list here, so I can kind of look at them in real time. If we look at the various futures, you will notice that when we got the VIX up 4 points yesterday, these futures are not moving that much. They are not, when we get these continue to move to the upside, they are moving up, but not very much. And thus, when we have a day like today with the VIX down 2 points, well, these are barely moving down, because they're sort of going to wait until the VIX actually comes down to meet them before they're really going to start moving lower to the downside. So because of the way the VIX term structure works, it can be disappointing for both people who are long UVXY, VXX, or short UVXY and VXX. At times, it can be disappointing because you don't get the move that you are expecting. And the reason for that is that this the term structure, when we go from several days of up move to several days of down move, it has to kind of readjust itself, and therefore it takes it kind of cushions any move that we have these futures do. So here I'm pulling up VIX Central here, and you'll notice that we have 2 points down move in the VIX spot or cash, which is this number here, 22.95. And these futures really, with the VIX moving from 25 to 22.95, these futures, they move down like 30 cents, something like that. And until we get more of a push follow through in the cash, these futures are just kind of going to lag. Now, if the market turns down again and this spikes up another 2-3 points, once again, these futures are not really up and going. In fact, they're pretty sluggish in their response right now. The only way you're really going to get the big moves is if we have a really serious spike, or if the market can turn around for a couple days and move back to the upside. Then you will notice this spot move through the futures, so it's below the futures, and then the term structure go back into contango. And it can be very frustrating because on a day like today, if you are short and you see, oh wow, the VIX is down 230, so UVXY probably will be down like a lot, and it's down some, but it's not down as much as you might think. Same thing to the upside yesterday. You see, VIX up 5. Well, this thing should really take off, and it just doesn't perform the same way as you would expect for a 1.5 times leverage instrument to perform. And the reason for that, like I said, is that the futures, they have sort of a mind of their own compared with the cash, and when we get a spike, the futures don't go up as much as you might think because they're anticipating the retracement back down. So once again, I apologize if you are just tuning in here and this is your first look at UVXY, VXX, and whatnot. I'm going a little bit more like a deep dive than maybe I should. So let me just back up for a second and explain that the VIX is a number based on a strip of puts in the SPX. Well, what does that mean? Well, most people who, let's back it all the way up, let's assume you know nothing about the stock market and whatnot. Most people who invest in the stock market do so through maybe their company 401k, something like that. And if you were to go to the average company and say, I want to participate in the 401k program, they would typically take out a certain amount from each of your check and put it in a fund that is customized for when you, for your age and when you would be predicted to retire. And the thought process behind that is the closer you are to retiring, the less of a stomach you have for taking risk. And so they would make a mix of bonds and stocks. Bonds being a more quote-unquote safe investment where you're just loaning money to a company and they're paying it back to you with a little bit of interest. Stocks being you actually buying a part of a company. And thus, depending on your age, if you're younger, they're going to have more of a mix of stocks. And if you're older, they're going to have more of a mix of bonds. And when I say a mix of stocks, these funds are generally going to be buying an index or a basket or a mutual fund, an ETF, a group of major stocks. And how does that relate to the VIX? Well, when they buy this group of stocks, if the fund manager starts to get nervous that the market might take a downturn, instead of selling the stocks back out, what they do is they buy protection. And the way they do that is by buying SPX puts. And when they buy protection, when a lot of people are buying protection, the price of the puts goes up, and that is reflected in the price of the VIX going up. And that is how sorry for that beep. That is how the VIX relates to the average person's investment in the stock market. So recently, we've had a lot of downside activity, as I showed you in the E-minis, and the VIX has been popping. Now, people who haven't traded the VIX before sometimes get interested during times like this in the VIX, and I get tweets and people asking me, well, how do I take advantage of this elevated VIX? Because it's going to, obviously the market is going to recover at some point, whether that be now, in 10 years, or sometime in between. And when it does, the volatility will come in, and so there's money to be made downside because of volatility coming in, and B, anybody who's studied UVXY, VXX, how these VIX products work, knows that they are not very efficient and they suffer from decay. So even if the VIX stays where it is, UVXY and VXX are destined to go lower at some point. If we take a look at the chart of UVXY over the last 3 years, you're going to see it going straight down. If we take a look at the chart over last 1 year or 6 months, you see it going straight up. So there's a little discrepancy there. Let's try 1 year. So 1 year, I'm in the way, but if I move a little bit, you can see downtrend, destined to continue at some point. We don't know exactly when. Same thing with VXX, 1 year chart. Yep, it's gotten a spike, but it's still lower than it was. Let's see. Actually, it's not. It's still lower than it was in February, but higher than it was at this point last year. Let's take a look at a 3-year chart in VXX. The 3-year chart in VXX is going to actually show you that even with the spike in February, we are still in a downtrend. And there's nothing, mathematically speaking, this is not just going to turn around and go straight up from now on. Statistically, we are in contango 80% of the time, and that mathematically means that these are destined to go down no matter what. As long as we're in contango more of the time than we're in backwardation, these are destined to go lower. So how do we take advantage of it? Well, we take advantage of it carefully because we know, what do we know? We know that it's going to go down at some point. We don't know when. So how do we take advantage of that? Well, we need a longer horizon in our thinking as far as these are concerned. We need to be patient, and we need to know that if we short this, it might go against us for a period of time before it comes back down, right? So, and I know a lot of people are smarting because they shorted it. You know, a typical spike only lasts a day or two. This particular situation has been going on for weeks now, so a lot of people are smarting. You know, people, if we look at this chart here, some people shorted it, you know, last Thursday, and it's gone against every day. I mean, these products have gone up every day for weeks. I mean, some days it went sideways a little bit, but then back up every day. So it's been pretty painful for many people. I know, but it will go lower at some point, and it just takes a little patience. So let's get into the nuts and bolts of exactly what trades to put on to take advantage of this. I'm going to take a little break, and we can come back and do that coming up next. All right, so welcome back. Let's talk about some actual strategies in VXX and UVXY. Too short volatility, giving us a good chance of making money. And the way to do that is to move our time horizon out a little bit. Now, you might feel that, well, this market down move is going to be over in the next week or so, and in which case you could put a trade on that could potentially double or triple your money. Or what I would suggest is you take a longer view and you look out a month or two, even to 3-4 months out to take advantage of and to be a little bit more conservative, but still make a great return. So let's first show you a conservative approach to make money, and then we'll show you a very aggressive approach if you are of the feeling that this market's going to turn around very soon. Maybe you think that as soon as the midterms are over, this market's going to turn around and go back up, or at least stabilize, and you want to have an aggressive trade to make the big money. I don't recommend that, but I will show you some ideas for that. But let's first talk about a conservative trade to take advantage of a potential downside move in volatility. And for that, I'm going to go to VXX here. And here's the chart of VXX. And I would be looking at probably buying a put spread, so buying one put and selling a strike of a lower put. So maybe buying so let's take a look. Right now, VXX 37.57, and it has come from a lot lower. So it's come from like 26, somewhere around there, to 37 in the last couple weeks. So it can definitely conceivably go back down towards 26. So you might like to take a look at maybe a Jan. Now you'll see VXX ends in January. This is because of the way the fund was set up a long time ago. It expires in January. The symbol will be changed after January to VXXB. It's the identical thing, but you'll see options going out past January in VXXB. The liquidity is not there in VXXB right now, but it will be come January. Okay, so let's go back to VXX, and I would recommend either buying put spreads or selling call spreads. And the reason I say that is these are limited risk trades where you know what you're risking and you know what you can lose, and if they go against you, you're not going to end up in a situation where you owe money to somebody or something like that, because volatility spikes can go against you big sometimes, and the VIX could spike back to 50 or 60 momentarily. It's not going to stay there, but it could spike, and you want to protect yourself. So I might recommend going out to let's say January, so that gives you 85 days, and maybe buying something like the January 33.30 put spread. So here I'm clicking on the offer of the 33 put, and then I'm clicking on the bid of the 30 put, holding control. So I can buy this put spread. The 33 put spread is worth up to $3. I could buy it for $1.35, and if things settle down before January, I can more than double my money, because I'm paying $1.35 for something that's worth $3. And I don't think it's unreasonable that this can go back to 30 in 85 days, because volatility generally stays. The VIX over the last few years has usually stayed around 12, 13. So it's not inconceivable that it can go back there pretty quickly. So if you want to be more conservative, you could do something like sell the 38 call and buy the 41 call in January. Okay, so each time you do that, you are you're basically betting $200 to make $90. So not a bad return on that one, and a little bit more conservative. So once again, selling the VXX Jan 38.41 call spread. That gives you some time. Another trade I was thinking about in UVXY would be to go out to March in UVXY and buy something like the March 40-30 put spread. So buy March 40 put. Now this is 141 days, a good period of time. So buy March 40 put, sell March 30 put. So you're paying $3.64 for something that could be worth up to $10. So if the market goes back to what it has been doing the last couple years, you could come close to tripling your money by putting this spread on. The other good thing about putting a March spread on in UVXY is that if things spike more against and this thing goes way higher, this spread isn't going to move all that much on a big spike. So you could potentially, if you put this March 40-30 put spread on, you could potentially take that money that's locked up on that spread. If we get a huge spike, take a small loss on that, and then redeploy that money in a closer term play to take advantage of a huge spike in volatility. So let's say, for example, tomorrow the market is down a lot and the VIX goes to 40. If you had this spread on, you would lose a little bit of money on it, but you could sell it out, take that money, and redeploy it in a shorter term play to make it back and make more. So that was a spread that I liked, March 40-30 spread in UVXY. Now, if we look at the open interest on these trades, the open interest is only is very small. You see open interest is like 280 contracts, 144 contracts. So this is not something that you could do in size, but it's something that you could do a few times and potentially do pretty well in. There's not a whole lot of liquidity in UVXY right now, so you want to keep that in mind. This is not the kind of trade that you want to be trading in and out of every day. It's the kind of trade that you want to put on and just leave it for months. And so let's look at another trade. Let's look at the March 50-40 put spread. Buy March 50 put, sell March 40 put. Okay, so this is closer to a trade where you could potentially double your money in 141 days, which sounds great, and it's definitely possible that that UVXY could be at $40 in 141 days. Conversely, if you wanted to be a little bit more conservative, you could buy the March 60-50 put spread. Pay $6.75 for something that's potentially worth $10. And that way, you've got plenty of time, 141 days, even if the market's going crazy all over the place, that gives you a lot of time for things to calm down. Okay, so let's take a look now just quickly at if you want to play something. Let's say that you feel that we're going to get a spike and you want to play it. You want to play to the short side right after you get a spike. So you want to be ready to put a trade on in the next big spike. So let's say tomorrow UVXY goes to 70 and you want to short that. Well, you could go out to maybe 16 November. It's only 21 days, 3 weeks, and you could buy a put spread. So if UVXY spikes to 70 tomorrow or next week, you could buy something like the 65 60 put spread, and right now it's worth $3.60, but if this spiked to 70, it would be worth like $2, and it would be a good risk reward type situation. So basically all the trades that I'm outlining right now in UVXY and VXX are buying put spreads of some sort. And if you're more conservative, you might consider selling a call spread that's where the strike you're selling is at the money as opposed to being in the money. When I buy a put spread here, I'm basically making a bet that this is going to go a lot lower, and the only way I'm going to make money is if it does go lower. If you sell a call spread where you're selling the at-the-money call, then if UVXY stays where it is, you can still make money. But the higher the strikes you're using, the less, the more probable it is that you're going to make money, but the less money you make. That's just kind of the way it works in the options world. If I sell the November 60-70 call spread, then I'm betting, I'm betting 700 to make 270. you're betting a lot of money to make a little bit, but there's a high probability that you're going to be right. If you're, however, selling the the 50-60 call spread, then if it comes in, you're going to almost double your money. However, it's a little bit less likely to come in. My feeling right now is that the market is going to do what it usually does, which is turn around, go back up, and the fear will be over for a while, and everything is going to come in, and all these products are going to go down. I think that probably during earnings, things are going to turn around a little bit, but we don't know what's going to happen, and certainly shorting volatility has not worked very much this year. I want to pull up for you for a second here a chart from VIX Central. And VIX Central is an interesting website but let's take a look at this chart here. All right, so this is going to show you the average contango as to over time, and I'm going to close up on just this year. Now, if you look at the year, and we're looking at the light blue line here now. So when this light blue line is above the red line, that's when we're in contango. And you can see we were way in backwardation for a little while in February, and then we stayed kind of in backwardation a lot in March and whatnot, and then we were in contango the rest of the year until now, where we're back in backwardation. You can see it's not been a great year for shorting volatility at all, and that's reflected any way you look at it. If you look at just looking straight up at UVXY or VXX, you can see it's been a rocky road. I mean, VXX started at 25.59 and hasn't gotten back there yet over a whole year. If you'd sold VXX the beginning of the year, you never would have made money the whole year, and that's very rare in the world of volatility. It's been a bad year for shorting volatility, and with the market, just off of all-time highs and not really having had that huge correction that everybody's been talking about yet, things could be difficult for a while to come. I mean, if we look at this chart here, this is what's happened over the last 3 years. And you can see we're even now with what's happened in the last month, we're still in an uptrend. I mean, it's going to take more damage for us to actually be out of this uptrend here. So certainly things can get worse. But at the same time, we are at a pretty a reasonable high place in the VIX. We're above the average price area in the VIX, and it seems like a good time to short volatility. If you have the stomach to wait it out, good things could come to you. I know that people have struggled. Last year, everybody was putting on the short vol trade, and they're like, oh, it's easy money, it's easy money. And a lot of those people that were saying it's easy money got taken out of the game in February. And it's nothing's easy money in the stock market. You have to take money away from somebody else in the stock market to make it. And the easy money of last year turned into a lot more tricky proposition this year. But doesn't mean it's not a viable trade. It doesn't mean that it's not going to work. We just have to move out farther and farther in time. You can feel much more comfortable with your trade if it's farther out in time. If you're putting on a trade, I wouldn't recommend putting it on in Nov. I recommend putting it on in Jan at least, maybe farther out, because that gives you time. Time is really on our side in the short vol trade, but it's been a month of going against us, and it's actually been like a year really of really not being profitable in this trade. And so with that in mind, widen your time horizon. Don't let time run out on you. Options can be a great way of shorting these things, but if you run out of time on your plays, it doesn't work. So broaden your time horizon, hang in there, and we'll see what we'll see. I can't predict the future, but these things tend to turn around, and that could be the case this time. I mean, it's funny how today E-mini's up 33, and everybody, I mean, there's not a feeling of euphoria at all because that's what our chart looks like right next to me. It doesn't look like we're in rally mode right now. We're just kind of coming off the lows a little bit. So it's going to take a couple days of up markets to sort of repair the damage that's happened recently. Hang in there. There are bargains out there in the stock market, I know. Careful, as always, in the MJ sector, of course. Thanks for watching. And yeah, please check me out. I will be on Volatility Views tomorrow, and I'll leave a link in the description. That's on the Options Insider Radio. Mark Longo is a cool guy. You should definitely check him out and check out Options Insider Radio. Really cool stuff, and highly recommended for you to check it out. Once again, just to kind of refresh your memory, the VIX right now, the spot is a lot higher than the futures. So any moves, it's going to take a couple days of upside moves for this situation to kind of normalize. So be patient, hang in there. Nice up day today, but it's going to take a couple up days for things to come back in line. So I look at the futures. I don't look at the price of VXX because it can be deceptive. Right now, down 90 cents, VIX down 2, but the reasoning for that is because we didn't go up as much yesterday as we, quote-unquote, maybe should have. So today we don't go down as much as we, quote-unquote, maybe should have. All right, thanks for watching, and I'll see you in the next one. And hang in there, folks. It will get better for the short vol trade.